accounting ratio is one of the important tool of financial statement analysis where the result can be measured in the form of ratios, proportions, percentage, etc. Whether the firm is in a position to repay the current liabilities or not. So that is known as what? Liquidity of the firm. By using current assets, you can calculate liquid assets. Your formula is liquid assets is equal to current assets minus inventories minus advance tax minus prepaid expenses. Hello everyone, I am Harshita, lecturer, Department of Commerce, Vidhyaashram PU College, the Temple of Excellence, Mysuru. My dear students, today we are in the second session of your chapter Accounting Ratios, and this is from Part B, Chapter 5. So from your Part B, this is the fifth chapter, Accounting Ratios, and today we are in the second session. So let us quickly recall what we have discussed in a previous session. So in the previous session, we have started with the introduction. We're telling about how accounting ratios or what is the requirement of an accounting ratios. So suppose if the financial statement is presented merely just with a statement, so an user cannot understand the financial statement properly. Suppose if they analyze the financial statement and it is presented in the form of ratios, proportions or percentage, then it can be understood easily. So where accounting ratio is considered one of the important tool of financial statement analysis. So accounting ratio is one of the important tool of financial statement analysis where the result can be measured in the form of ratios, proportions, percentage, etc. So that the comparison as well as the results can be ascertained very quickly as well as very easily. So that was the introduction. Now coming to meaning of ratio. So it is a relationship between two or more numbers. So where it is being expressed in the form of fraction or it is expressed in the form of ratios. Next we have discussed about accounting ratios. So accounting ratios is related to the accounting statement, the data in the accounting statement which is measured in the form of ratios or which is measured in the form of fraction, where we are going to consider the relationship between the two accounting data of a financial statement, that is known as what? Accounting ratios. Next, objectives of ratio analysis is of course the comparison will be very easy when the financial statement is expressed in the form of ratios where the relationship is being expressed as well as it is being presented in a understandable manner. So it has been or your financial statement can be understood very easily. Comparison can be made. Even the forecasting can also be made by using this ratio analysis. So we have discussed few more objectives on ratio analysis. Next was advantages, limitations as well as classifications of ratios. Of course, we have lot of advantages as well as limitations also in the accounting ratios. So if you see the advantages, yes, of course, I have told you it is being presented in an understandable manner where the comparison from firm to firm as well as from one year to another year can be done also. At the same time, we have lot of other advantages like forecasting will be done very easily. So these were the advantages. Now coming to your limitations, suppose if there is any disadvantage in the financial statement, it also affects on financial statement analysis. That is your ratio analysis. Suppose if the financial statement, the accuracy is not proper, then of course it affects the ratio analysis also. Or if there is any window dressing where a fair financial position is presented or a fake financial position is presented in the financial statement, it also affects the ratio analysis. So there are a lot of advantages as well as disadvantages of ratio analysis also. Next, we have learned about classification of ratios where there are 4 types. Today in this session, we are going to learn about the first type of accounting ratio, that is what? Liquidity ratio. Now let us see what is this liquidity ratio. Here under liquidity ratio, we are going to or mainly we are going to compare our current assets with that of current liabilities. Okay, so let us see what is this liquidity ratio. Liquidity refers to the ability of the firm to meet its current liabilities. So what do you mean by liquidity ratio? Liquidity means what? Whether the firm is in a position to repay the current liabilities or not. So that is known as what? Liquidity of the firm. So liquidity in the sense current liability where the liability is paid within 1 year. So whether the firm is in a position or whether the firm is in a condition to repay that liability which has to be repaid within 1 year. So that is known as what? Liquidity. So liquidity refers to the ability of the firm to meet its current liabilities. The liquidity ratio therefore are called as short-term solvency ratio. So why it is called as short-term solvency? Because the repayable period will be within 1 year. So that is known as what? That is short-term solvency ratio. These ratios are used to access the short-term financial position of the concern. So I have already told you. So here we are going to see that whether the firm is in a condition or whether the firm is in a position to repay the current liabilities or not. They indicate the firm's ability to meet its current obligations out of the current resources. So whether we have that sufficient amount of current assets where we are able to repay that current liability which has to be repaid within 1 year. So let us see what are the types of liquidity ratios. Liquidity ratio includes two ratios, that is current ratio, or it is also called as working capital ratio, and the second one is quick ratio, or it is also called as acid test ratio or liquid ratio. So what are the two types of liquidity ratio? So we have current ratio or working capital ratio, and the second one is quick ratio or acid test ratio or liquid ratio. Now, in this today's session, we shall solve few of the problems relating to current ratio as well as quick ratio. So, normally, if you see your old question paper pattern, they used to ask this calculation of current ratio and quick ratio for 6 marks. Okay, so let us see. As per the new question paper pattern, you don't get a question, but theory questions will come from this liquidity ratios. Okay, so go through that. Now coming to current ratio or working capital ratio. So let us see what is this current ratio or working capital ratio. So current means what? Day-to-day expenses. So it may be receiving of an amount or repayment of an amount which comes within 1 year. So that is known as what? Current. Okay. So this ratio explains the relationship between current assets and current liabilities. So what we are going to mainly consider under current ratio, that is all our current assets as well as current liabilities of a business. The formula for calculating the current ratio is current assets divided by current liabilities. Hope the formula is very simple. So what is the formula of current ratio? Current assets divided by current liability. So here mainly we are going to consider our current assets with that of current liabilities. Now let us see what is this current assets. Current assets are the assets which are likely to be converted into cash or cash equivalents within 12 months from the date of balance sheet or within the period of operating cycle. Now, what do I mean by current assets? So, these are the assets of the business which can be converted into cash or cash equivalents within 1 year, that is within 12 months. They are all considered as what? Current assets. So, the best example will be your debtors. So, these are all current assets, bills receivable, cash, bank, all these are current assets which can be converted easily into cash or cash equivalents within 12 months or within 1 year. Now let us see what is current liabilities. So you know liability means the amount that has to be paid to the outsiders, or the amount due to be paid to the outsiders are called as what? Liabilities. Now let us see what is this current liabilities. So current assets which can be converted into cash or cash equivalents within 1 year. They are considered as what? Current assets. Then what is current liabilities? Current liabilities are the liability which are repayable within 1 year or within 12 months from the date of balance sheet or within the period of operating cycle. So, what do you mean by current liabilities? Current liability means what? The amount which has to be paid to the outsiders, that is within 1 year. That is known as what? Current liability. So, hope you are clear about the formula of current ratio. So, the formula is current assets divided by current liability. So, what do you mean by current assets? Those assets of the business which can be converted into cash or cash equivalents within 12 months. They are all considered as what? Current assets. Coming to current liabilities. So, these are the liabilities which are payable or which is due within 1 year. Payable within 1 year or 12 months, they are all considered as what? Current liabilities. So hope you are clear with current ratio. Now let us see what is this quick ratio. So quick ratio indicates whether the firm is in a position to repay its current liabilities within a month or immediately. Now see here, under current ratio, they have given a time duration of 12 months. But on a quick ratio, it has to be paid immediately or within a month. Okay, so quick ratio indicates whether the firm is in a position to repay the current liability within a month or immediately. That is known as what? Quick ratio. As such, the quick ratio is calculated by dividing liquid assets or quick assets by current liability. So what is the formula for quick ratio? Liquid assets divided by current liability. So the formula of current ratio is current assets divided by current liability. The formula of liquid or quick ratio is equal to liquid assets divided by current liability. Now let us see what is this liquid assets. Liquid assets are the assets which are to be converted into cash and cash equivalents very shortly. Okay, so current assets means what? They will give a duration of 1 year or 12 months. But here liquid assets, it is more liquid than your current assets, which has to be converted more quickly than your current assets. So liquid assets are the assets which will be converted into cash or cash equivalents very shortly. They are all termed as what? Liquid assets. So what is the formula of liquid assets? Liquid assets is equal to current assets minus inventories minus prepaid expenses minus advance tax. So how do you get liquid assets? By using current assets, you can calculate liquid assets. Your formula is liquid assets is equal to current assets minus inventories minus advance tax minus prepaid expenses. So this will be the formula of liquid assets. So hope you are clear with this current ratio as well as quick ratio. Quick ratio is also called as acid test ratio or liquid ratio. So hope you are clear about it. Now we shall directly go through the problem here. So calculate current ratio and quick ratio from the following information. So these are all few of the question paper problem what they have asked in the previous year. As I have told you, as per the current question paper pattern, you don't get the question for 6 marks on current ratio or quick ratio, or else every year they used to ask for 6 marks. Okay, now go through the question here. Calculate current ratio and quick ratio from the following information. So they have given us few particulars and amount. Stock 25,000, debtors 20,000, bills receivable 5,000, advance tax 2,000, cash 15,000, creditors 30,000, bills payable 20,000, bank overdraft 2,000. Now what we have to calculate? Current ratio. So what is the formula of current ratio? Current assets divided by current liability. So the formula of current ratio is equal to current assets divided by current liability. So what are the current assets we have here? So using the information, we have to calculate current ratio. So stock is an current asset, debtors current asset, bills receivable current asset, advance tax current asset, cash current asset. So these are all what? Current assets. Coming to current liabilities, creditors, bills payable, bank overdraft, current liability. So how we have to add all these amount. So you will get total current assets, divide by, add all these, you will get total current liabilities. So current assets divided by current liability, so that you will get the current ratio. Now let us see the solution here. Current ratio is equal to current assets divided by current liability. So I have taken all the current assets. So stock is a current asset, debtors, bills receivable, advance tax, cash. So the total current asset is rupees 67,000. Now current liabilities, creditors, bills payable, bank overdraft. So you'll get 52,000 as current liability. Now apply the formula. Current ratio is equal to current asset 67,000 divided by current liability 52,000. So you'll get 1.29 divided by 1. So how you have to write in the form of fraction? 1.29 is to 1. So this is what? Current ratio. So very easy problem. Just you have to know how to segregate which are the current assets and which are the current liabilities. Now in the same way we shall calculate quick ratio. So your formula is quick ratio is equal to quick assets divided by current liability. Anyhow we know what is current liability, that is 52,000. So already we know current liability is 52,000, but we don't know what is quick assets. So we have to apply the formula. Quick assets is equal to current assets minus inventories or minus stock minus advance tax minus prepaid expenses. But in this question what you have? So if you see the question, we know current assets, total of current assets minus stock. So we have to deduct stock, that is inventories, minus advance tax. So they have not given prepaid expenses, so no need to bother. So just what they have given, you will deduct all that. Okay, so your formula is quick assets is equal to current assets minus stock minus advance tax. So current assets already we know, we have calculated, that is current assets is how much? 67,000 minus stock 25,000 in the question minus advance tax 2,000. So you will get quick assets. So we know quick assets 40,000, current liability is how much? 52,000. So 40,000 divided by 52,000, you will get 0.77 divided by 1. That is 0.77 is to 1. So this is your answer. Now coming to the next question. From the following particulars, calculate current ratio and quick ratio. So they have given this particulars like inventories 1,20,000, trade receivable 90,000, cash in hand 22,800, current investment 7,200, then trade payable 2,34,000, proposed dividend 6,000, bank overdraft 60,000. Now same way you have to write the formula and calculate. So what is the formula? Current ratio is equal to current assets divided by current liabilities. So what are the current assets we have in the question? So inventory, that is stock, is a current asset. Trade receivable is a current asset. Cash in hand is a current asset. Current investment. So these are all what? Current assets. Now trade payable, proposed dividend, bank overdraft. So what are these? So these are all what? Current liabilities. So these are all current liabilities. Now you can directly apply the formula. You have to add all these so that you will get total current assets. Add these three, you will get total current liabilities. Apply the formula. So current ratio is equal to current assets divided by current liability. So current asset you will write one by one. That is inventory 1,20,000, trade receivable 90,000, cash in hand 22,800, current investment 7,200. So the total current assets is 2,40,000. Now coming to current liability, we have trade payable 2,34,000, proposed dividend 6,000, bank overdraft 6,000. So the total current liability is 3 lakh. Now you can apply the formula 2,40,000 divided by 3 lakh. So how much you'll get? 0.8 divided by 1, that is 0.8 is to 1. Okay, so this is what? Current ratio. Now coming to quick ratio, what is the formula? Quick assets divided by current liabilities. Now which are the quick assets? So quick assets are, so you can apply the other formula also, current assets minus inventories minus advance tax minus prepaid expenses. So quick assets is trade receivable, cash in hand, current investment. The other way to apply the formula is what? To quick assets, current assets. Quick assets is equal to current assets minus prepaid expenses minus inventories minus advance tax. Now how much is current assets? So current assets, so we have, that is 2 lakh rupees, 2,40,000 minus inventories. So we have stock, correct? So stock is how much? So inventories is 1,20,000. So inventory is 1,20,000 rupees, 1,20,000. So how much will get? 2,40,000 minus 1,20,000. So we'll get 1,20,000. This is what? This is quick assets. So rupees 1,20,000. This is quick assets. Because we don't have prepaid expenses as well as advance tax. So your formula will be quick assets is equal to current assets minus inventories. So same you will get here also, that is if you apply this also, so that is 1,20,000. So quick ratio is equal to current assets, that is quick assets 1,20,000 divided by current liability is 3 lakh. So you will get 0.4 divided by 1, that is 0.4:1. So hope you are clear about this question. Either you can calculate like this or you can apply the formula. Quick assets is equal to current assets minus inventory minus advance tax minus prepaid expenses. So depending upon the question what they have given, in this question they have given only inventories. They have not given advance tax as well as prepaid expenses. So you will just take current assets minus inventory. So that you will get rupees 1,20,000 only. So you can either calculate like this or you can apply the formula like this and calculate. Okay, so hope you are clear about quick ratio. Now coming to the next problem. So this was the simple problem what they have asked in your previous question paper. Few times they have asked directly. So few times they have given separately where you have to segregate them into current assets as well as current liabilities. Now go through this question. From the following, calculate current ratio and quick ratio. Your formula remains same. Current ratio formula is current assets divided by current liabilities. Quick ratio formula, quick assets divided by current liabilities. Now they have given us directly. So they have given current assets 2,40,000, stock or inventories 1,20,000, current liabilities they have given 60,000. Now what is the formula? Current ratio is equal to current assets divided by current liabilities. What is current assets? 2,40,000 divided by current liabilities 60,000. 2,40,000 divided by 60,000, 4 divided by 1. So your answer is 4:1. Next, quick ratio, your formula is quick assets divided by current liabilities. Now, what is the formula of quick assets? Current assets minus inventories. Correct? So current assets minus inventories. So that is minus stock, you will get 2,40,000 minus 1,20,000, that is 1,20,000 will be your answer. Quick ratio, you know the current liabilities already you know that is 60,000. So quick ratio is equal to 1,20,000 divided by 60,000, 2/1. Your answer is 2:1. This is quick ratio. So hope you are clear. Directly they have given in this question. So you can directly apply through the formula. Just you had to calculate the quick assets. So quick assets already you know the complete formula, current assets minus inventories minus advance tax minus prepaid expenses. So depending upon the problem you will deduct. Okay. Now coming to the next question, similar type of question. From the following, calculate current ratio and quick ratio. So they have given current assets, quick assets and current liability. Everything they have given us directly, just you have to apply the formula. Okay, so your formula is current ratio is equal to current assets divided by current liabilities. So current asset is 1,44,000 divided by current liability 1,04,000. So how much you'll get? 18 divided by 13. So if you calculate that, it will be 1.38:1. Now coming to quick ratio, your formula is quick assets 90,000 divided by current liabilities 1,04,000. So how much you'll get? That is 45 divided by 52, 0.865:1. So hope you are clear. Very easy sum which was asked for 6 marks, but as per the new question paper pattern, you don't get a question for 6 marks. But remember the formula. So under current ratio as well as quick ratio, you are going to compare your current assets with that of current liabilities. So what is the formula of current ratio? Current assets divided by current liability. What is the formula of quick ratio? Quick assets divided by current liabilities. So remember the formula, and what is the necessity to calculate this liquidity ratio? What is this liquidity ratio? To see the business is in a position to repay the current liabilities or not. So what are current assets? So these are the assets which can be converted into cash and cash equivalents within 1 year. They are all termed as what? Current assets. What is current liabilities? So these are the liability which will be repayable within 1 year. They are all current liability. So you might get a question, give the example for current liability, give the example for current assets. For that reason, you can go through this. Or they might ask you, what is the formula of current ratio? What is the formula of quick ratio? So this would be helpful for you if you go through this liquidity ratio. So in my next class, we shall solve problems, or we shall see what is the solvency ratio, and we shall solve problems on solvency ratio. This is a second type of accounting ratios. So my dear students, hope you have understood today's session. See you all in my next session with a new topic. Till then, take care. Thank you.